People hear auto loan rates are down and assume car payments should be getting easier, but the monthly payment can still climb, even when the interest rate cools. By the end of this video, you'll be able to look at any car deal and explain in plain English why the monthly payment is high, which lever is actually driving it, and what 3 signals to watch next so you can tell if the pressure is easing or building. Here's the recent headline that matters. New car loan rates have eased to around a 3-year low in some tracking, but the average monthly payment still hit a new record in December, around $781. And at the same time, the Federal Reserve just held its target range for the federal funds rate at 3.5% to 3.75%. That combo confuses people. Rates are not rising, and in some places, they're drifting lower. So, why are payments still ugly? Picture someone shopping for a mid-level sport utility vehicle. They're not trying to be flashy. They just want something reliable. They walk into the dealership thinking the rate is the main problem because that's the headline. Then the payment quote comes back, and it's a number that makes their stomach drop. So, what actually happened in the real world? The event is simple. Borrowing costs stopped getting worse at the top, and some loan rates have eased. That's the rate side. The market response is what you'd expect. Lenders and dealers lean into longer terms and creative pricing to keep the monthly number workable. You see more 7-year loans. You see more offers that focus on monthly payment instead of total cost. And you see shoppers stretching because the sticker price is still high. Then you get product repricing. Not just the interest rate, but the whole deal structure shifts. The loan gets longer. The amount financed creeps up. Add-ons get rolled into the loan. Trade-ins with leftover balances get folded in. All of that changes the monthly payment even if the interest rate itself is calmer. Then it hits your wallet. A record average payment tells you the squeeze is now living at the monthly level, not just in a chart. And the people who get hit first are the ones with the least flexibility. Buyers with small down payments, buyers whose credit is good but not elite, people replacing a broken car on a deadline, and anyone rolling old debt into a new loan. Now, let's translate the mechanism without making it feel like math class. A car payment has 3 big drivers: the price of the car, the amount you actually finance, and the interest rate you pay on that loan. Term length is the amplifier. It can make a bad deal look okay on the surface, or make a good deal feel expensive if the amount is too big. Here's the key misread. A lot of people treat the interest rate like it's the whole story. It's not. If the price and the amount financed rise faster than the rate falls, the payment still goes up. Let's do a simple example with round numbers. Say deal A is a $35,000 loan at about 7% over 5 years. Deal B is a $43,000 loan at about 6.5% over 6 years. Deal B has the lower rate, but it can still have the higher payment because you're financing more dollars for longer. That's the first lever. More dollars financed beats a small rate drop. This is why a 3-year low in the interest rate doesn't automatically save your month. Now, the second lever is the one people don't feel until they're already committed: term length. Longer terms can lower the monthly payment today, but they often raise the total interest paid over time. And they keep you upside down longer, meaning you owe more than the car is worth for more months. So, back to our shopper with the sport utility vehicle. So, what changes for this person? If they focus only on the monthly payment, they can end up in a longer loan with a bigger balance, even if the rate looks better than last year. They get a payment they can barely tolerate, and a loan that's hard to escape. There's also a counterpoint that's worth saying out loud. Another reason you might still see record payments is mix. If more people are buying bigger, more expensive vehicles, the average payment rises even if the typical deal doesn't change much. So, the practical way to frame the record number is this. It's a sign that the market is still pushing people into higher-priced purchases and higher balances, even as rates stop climbing. Now, let's connect it to the Federal Reserve decision, because that's part of the confusion. When the Federal Reserve holds its policy rate, it mainly sets the tone for short-term borrowing costs. Auto loans don't move in lockstep with that policy rate. They're priced by lenders based on their own funding costs, competition, and risk. So a hold can still coincide with auto loan rates drifting lower if lenders want volume, or drifting higher if credit losses rise. That's why the rates held headline doesn't tell you what your dealership quote will be next weekend. Here's the clean cause and effect chain. Policy rates influence general borrowing conditions. Lenders set pricing and terms. Dealers package the monthly payment, then the consumer gets the bill, and when the payment hits record territory, the personal finance impact shows up fast. Debt and interest, because a big auto payment leaves less room for anything else. Credit access, because high fixed payments make it harder to qualify for the next loan. Budgeting, because one bill can crowd out groceries, savings, and repairs. If money's tight, the important question is not, are rates down? It's, what is driving this payment in my deal, and what can I control? In the next part, we'll break down the 3 most common reasons payments keep rising even when rates ease, and we'll run the same shopper scenario through each one so you can spot it instantly when you see it. There are 3 common reasons the payment stays high, even when the rate looks better. First, the starting price is still elevated. Kelley Blue Book's early estimates put the average price paid for a new vehicle in December at about $50,300, an all-time high. If the price is high, the amount you finance is high. And if the amount you finance is high, the payment is high. So, what changes for our shopper? They walk in expecting a normal SUV price, but the out-the-door number is higher than the sticker for reasons that add up fast. Sales tax, registration, dealer fees, and sometimes add-ons that get bundled into the loan. Even if the rate improved, they're borrowing more dollars than they planned. A second explanation is mix and incentives. Sometimes the average rises because more people are buying higher trims or bigger vehicles. And sometimes the payment stays high because incentives are not doing enough to offset the price. So, the practical way to frame it is simple. If prices are near records, the rate has to fall a lot to rescue the monthly number. Now, the second reason. Negative equity and longer terms. Negative equity is when your trade-in is worth less than what you still owe. That gap does not disappear. It gets carried into the next loan. It is like starting a new race 2 laps behind. So, what changes for our shopper? They trade in a car they still owe $3,000 on. The dealer pays off the old loan, then adds that $3,000 into the new one. Now they are financing the new car plus the old car. Their monthly payment jumps, and they do not always see why. Owe $18,000, trade-in value $15,000. That $3,000 gap becomes part of the new loan. On a 6-year loan, that extra balance alone can add around $40 to $50 a month, depending on the rate and your term choice. This is where long terms show up. A longer term can make the bigger balance look manageable month to month, but it usually increases the total interest paid, and it keeps the balance higher for longer. That can trap people in the cycle where every trade-in carries a leftover balance forward. Another reason this might not show up right away is that the pain is delayed. A long loan can feel okay on day 1. The squeeze shows up later when maintenance hits, or when the buyer tries to sell and realizes they still owe more than the car is worth. So, the practical way to frame it is this. A longer term can lower today's payment while raising tomorrow's exit cost. Now, the third reason. Credit tiers and lender behavior. Even when average loan rates ease, your rate is still personal. Lenders price risk. If delinquencies rise, or if lenders get cautious, the best offers stay reserved for the strongest borrowers, and everyone else sees higher rates, higher required down payments, or fewer approvals. So, what changes for our shopper? They might be only a few notches below top tier. Not bad credit, just not perfect. That can be the difference between a decent APR and a painful one. And if the lender wants more protection, the offer can come with a shorter approval window or a required down payment that forces the buyer to stretch. This is why a record monthly payment can coexist with rates are easing. Experian's quarterly data has shown new car payments in the mid-700s in 2025, even before this new record number. So, the direction has been up for a while. The latest record is the top of that pressure. Now, let's turn this into decision rules that are actually usable. If you have to buy now, your best lever is the amount financed. That means you look at the out-the-door price, the trade-in payoff, and the add-ons. Then you ask one clean question. How many dollars am I borrowing, total, after down payment and trade-in? If you can wait, your best lever is timing and selection. When incentives rise or when transaction prices cool, you are not just saving a little. You are shrinking the balance that every future interest charge sits on. If cash is tight, the risk is the fixed payment. A common approach is to set a maximum monthly payment that leaves breathing room for insurance, fuel, and repairs. The upside is stability. The downside is you may have to choose a cheaper vehicle, a larger down payment, or a longer search. If cash is flexible, the risk is total cost. One option some people consider is focusing on the shortest term they can comfortably handle. The upside is paying less interest and getting out of the loan sooner. A potential downside is the payment can be higher in the near term. None of that is a recommendation. It is just the map of trade-offs. Now, the 3 signals to watch with where to look, what direction matters, and the typical timing. Signal 1 is the average price paid and the incentive picture. Where to look. Kelley Blue Book's monthly affordability and transaction price reporting and manufacturer incentive pages for the models you care about. What direction matters. If transaction prices flatten or fall and incentives get larger or more common, that usually eases payments for new buyers first. Typical timing. These updates are monthly, and incentives can change week to week, especially near month end. Signal 2 is the loan rate and term by credit tier. Where to look. A lender pre-approval quote, plus broad trackers like Bankrate's auto loan reporting, and lender dashboards you can check without a hard pull. What direction matters. Rates drifting down helps, but the bigger tell is whether the typical term shortens. If terms start shrinking from 72 months back towards 60, that often signals affordability is improving. Typical timing. Rates can move within weeks. Terms and approval standards usually change more slowly, over months. Signal 3 is auto loan stress in the system. Where to look. Quarterly consumer credit summaries and delinquency trend reporting, including the quarterly auto finance reports that track delinquencies and balances. What direction matters. If delinquencies rise, lenders often tighten. That can mean worse offers even if policy rates are steady. If delinquencies stabilize or fall, approvals and pricing can loosen. Typical timing. Delinquency data is slower. Expect a quarter-level lag. Now, a 2-minute checklist you can run before you agree to a payment. First, find the amount financed. Not the sticker, not the monthly, the amount financed. That is the number you are truly borrowing. Second, find the term, how many months. If the deal only works at 84 months, that is a clue the vehicle is too much for the budget, even if the payment looks okay. Third, find the APR and the finance charge. Ask for the full breakdown in writing. You want to see how much interest you pay over the life of the loan, not just the monthly. Fourth, check the trade-in payoff versus the trade-in value. If you are upside down, name the number out loud. That number is entering the new loan unless you cover it another way. Fifth, scan for add-ons, warranties, protection packages, gap coverage. Some of these can be useful in the right situation, but rolling them into the loan increases the balance and the interest paid. Sixth, get an insurance quote before you finalize the deal. The loan payment is not the full monthly cost of owning the car. Insurance can change the whole affordability picture overnight. Now bring it back to our shopper. So, what changes for this person? If they run that checklist, the deal stops being mysterious. They can point to the real driver. It is the price, or it is the negative equity, or it is the term stretching, or it is the credit tier. And that clarity matters because it protects the rest of the budget. A high fixed car payment is a pressure valve on everything else. Debt payoff slows down. Savings get skipped. Small surprises get put on a card. That is how a single purchase can quietly drag multiple wallet lanes at once. To close, here's the calendar piece. The Federal Reserve's next scheduled meeting after January is March 17th to 18. That does not directly set auto loan offers, but it shapes the rate backdrop. Between now and then, watch those 3 signals: prices and incentives, loan terms and tiered pricing, and delinquency trends. If prices cool and incentives rise, you usually see relief first at the dealership. If rates fall but terms keep stretching, the market is still fighting affordability. And if delinquencies climb, lenders can tighten even if headlines feel calmer. One print isn't a trend, but your payment quote is real. And once you know which lever is driving it, you stop shopping blind. If this helped, subscribe to the Wealth Blueprint for more clear money breakdowns. And leave a comment with the next topic you want covered, or the one part of today's video you want explained even simpler.